Welcome to the DIY Wealth Canada podcast, a show by independent investors for independent investors. Join hosts Bob and Nelson as they discuss investing, personal finance, and much more, all from a fiercely self-reliant Canadian perspective. As a reminder, nothing you're about to hear is investment advice. Thanks for listening and enjoy the show. All right, everyone, welcome to the special live season finale edition of the DIY Wealth Canada podcast. I'm Nelson. I'm one of your hosts alongside Bob. As always, we are very excited about our first ever live episode, and we will apologize in advance for any of the tech malfunctions that we have because it's the first time that I think either Bob or I are doing this. We are going to take your questions. For those of you listening live here, we're on X, Twitter, whatever you want to call it. Just request the mic at some point and we will get to your questions. Feel free to ask follow-ups or whatever. I think we'll record for about an hour, Bob, and then that'll be our show. So, Bob, anything to say before we get started?
Yeah, this one should be interesting, and hopefully the audio quality is okay. It's a little bit different setup than what we usually do.
No, I think you sound actually really good. So I'm going to ask Bob, what's your current take on the best Canadian dividend stocks for someone starting fresh in 2026?
Ooh, that's a tough one given the market condition because everything seems to be a 52-week high. Just the other day, I'm not the one that usually tracks stocks individually very closely. I just take a look at our portfolio and then I'm like, okay, it went up or down today. I was surprised CNR is around 52-week high because it really got hammered the last few months, right? So I was pretty surprised. But yeah, the best stock, if I were to start today, you can't go around with any of the two big Canadian banks, right? Either Royal Bank or TD. I realize both of them are around 52-week high. So it might be hard to hit the buy button when it's at 52-week high, but things could continue to go up. I would probably go with one of them, TD or Royal Bank. If now I was starting fresh, I might lean more toward either VEQT or XEQT or even HEQT, one of those all-in-one ETFs, just to give you a little bit more diversification. Then you don't have to track everything. Yeah, so that would be easier. So yeah, my answer would be maybe TD or Royal Bank because the banks have done really well over the years. The sleeper pick, I would probably either pick Brookfield Corporation or Brookfield Asset Management. Now, if you want a little bit yield, I would maybe pick Brookfield Asset Management, BAM. I think the yield is about 4%. And then Brookfield Corporation is more of a total return play. There's some proposal of restructuring Brookfield, which I'm doing some investigation. So that one might be a little bit more complicated if you are thinking of getting Brookfield Corporation. So yeah, those would be my answers. Nelson, what about you?
For those of you who read my newsletter, it seems like about the last, give it 2-3 months, it's just been me relentlessly complaining about how there's nothing to buy in Canada. I think Canadian stocks in general are overvalued. And I struggle with this because it's like, I do feel like there's a little bit of anchoring bias on my part because I look back at 2022, 2023, when these boring dividend stocks that I like so much, just they sold off and they got ridiculously cheap. And there was Royal Bank was offering almost a 5% yield. CIBC was offering close to a 7% yield. TC Energy, Enbridge were both offering close to 8% yields at their bottoms. Fortis was close to a 5% yield at one point. Those stocks went from being cheap to not so cheap. And there's a lot of people saying they're overvalued, especially the banks. I tend to agree. But at the same time, it's like I was the guy who I looked at Royal Bank at 180 and I was like, I don't know, it seems a little bit excessive. Of course, now it's 280, almost 290 as we record this. So I struggle with finding value in the Canadian market. And I'm much more inclined to look at the US market right now. But that comes with its own set of difficulties. One being that the Canadian dollar right now is at a close to an 18-month low versus the US dollar. And when you convert your Canadian dollars over, you don't get as many US dollars for that. And therefore, the dividend income that I'm getting from these US assets just isn't as attractive as what it is before, and it won't be as attractive unless the Canadian dollar kind of cooperates with it. I would rather wait until there's a pullback. I think BAM is a good value right now. That is a good place to start. Brookfield Asset Management. I think that Pet Value is a interesting choice in Canada. Trades at about 12 times earnings, and the secular play of pet ownership is a good one. I am starting to look at the telecoms again. They've gotten quite cheap. I'm not sure. I don't really love the telecom business, so I'll just kind of leave it there. There's a couple choices that maybe someone could go for, but honestly, like BEQT, XEQT, whatever kind of broad market ETF that maybe doesn't have quite as much exposure to Canada, I don't think that's ever a bad choice. And especially today where, I think that in general, the US market's probably a little more attractive than the Canadian market. Okay, so I talked about, and
We're going to talk about telecom. I was going to ask,
Telecom.
this next question. Yeah, let's talk about telecom.
Go ahead.
That's always the biggest one. Yeah, like TELUS and BCE, and I guess to some respect, the Rogers in under pressure. So the biggest question everybody seemed to ask is, can TELUS maintain its dividend with a cut? If you look at the Canadian telecom sector, would you add, hold, or trim right now? What's your feel?
Okay, the TELUS dividend, I'll start with that because that's always seems to be what people want to talk about. I think there's a 50% cut coming, and the new CEO coming in has the perfect excuse to do that. So if you own it, like I would expect that. Saying that, in terms of the TELUS's valuation, it's gotten to the point where it's quite attractive. I think it's about 11, 12 times free cash flow. And then free cash flow is expected to increase over the next, call it 2 to 3 years, as CapEx spending goes down. And I think that the new CEO is going to be able to come in and look at TELUS is a little bit of a collection of, it's almost like a shiny thing kind of syndrome. They've got a bunch of stuff going on that isn't really telecom. And if I were the new CEO, I would really focus that company back into telecom again. And I would get rid of a lot of the other stuff that they had, that they wanted to buy or kind of create in order to have this growth that wasn't just coming from telecom. So that's what I would do if I was a CEO, and I would take the proceeds and I would pay down debt. And then the interest that you save should, in theory, increase free cash, and it all should result in increases. But at the end of the day, I'm going to look at them fresh again because like TELUS is flirting with a 52-week low. BCE is down. Cogeco is down as well. So I'm going to look at them all again. Right now, my favorite one would probably be Cogeco, but Cogeco has its own set of problems with the US part of their business is just getting annihilated, and broadband in the US is just looks like a really tough business right now. I think they need to sell that part of the business and then focus on Canada, which is comparatively much better than the US. They can squeeze some earnings growth out of that. So I would say Cogeco is probably my favorite one right now, but that's not a strong buy recommendation by any means. I have to do more work in order to see what's going to happen there and whether there's actually a good chance that the US assets will be sold. And then at that point, you're speculating on a takeover or some sort of like corporate event, which is just something I really don't like to do. Bob, anything to add?
Yeah, I think I'm in agreement with you. I think TELUS will probably cut 50% in the dividend payout. Like every time we own TELUS and BC, every time I look at the share price, I think it's at 52-week low. Maybe it makes sense to go in and add a little bit, and they both surprised me and dropped further. I think TELUS just went below $16 earlier this week. I don't know where the bottom is. I feel like the price for TELUS is people already price in the dividend cut that's coming. So maybe it won't go down further. So if you're bargain hunting, maybe it makes sense to dabble a little bit, fully knowing that, and with the expectation that you're not going 10% yield moving forward. Maybe it'll go down to 5% or even lower. If you're okay with that, and maybe that's okay. Now, I would not back on my truck to load up on TELUS and BC at this point. Maybe a little bit of your portfolio. For us, we hold both towers and BC less than 1%, actually lower than that, maybe close to 0.5%. Of our portfolios, I'm holding both of them right now. I'm not actively adding, so we'll see what happens. So yeah, it's interesting.
I'll quickly add before we go to the next question that my largest telecom position now has been Quebecor. It's done incredibly well, including dividends. I've probably doubled my money in, call it 3 years. It's just been a really good performer for me. And I did not really expect that when I bought it. It was this value play that I was like, yeah, I'll get a little bit out of it, then maybe flip it and kind of go from there. But they've done an excellent job taking share from the big three. And that's what's driven the share price. Okay, we're going to go to the next question here. Before we do, just a reminder, everyone, feel free to request the mic and ask your own questions if you'd like. If not, feel free to just listen, but we're hoping to get a few live questions as well. In the meantime, let's go to another question we have in the bag, which is hedged versus unhedged ETFs for a Canadian holding US international exposure. Bob, do you think that you should hedge that exposure, so to take the currency out of it, or just let it ride and see what happens?
Yeah, I have written about hedge versus unhedge a few times on my blog, Talkin.com. We don't hedge. We just invest in US dollars amount. But in terms of ETF, even we were to buy ETF, we generally speaking buy the unhedged one. Now, my view is hedge, you may get a little bit of benefit in the short term, but over long term, unhedged will be just fine because with the currency going up and down, it'll smooth out over time. So if you're paying that extra fee for hedged, if you're holding for a very long time, I'm talking like decades, you're just paying extra fees, I think. Nelson, what do you think?
My view is over time, the currency is going to be a wash. Now, look, lots of people like to speculate on currencies, the kind of short term, where's the Canadian dollar going to go? Where's the US dollar going to go? And my view is that every minute that I spend worrying about that is a minute wasted. The point is, I think that over time, it all just washes out. So at that point, why are you paying for currency hedging? Because the ETFs have to, this has a cost. The ETFs just pass that on to you, the investor. So my view is that why bother with any of that if you think that it's going to all come out in the wash anyway. If you have a strong opinion on currency flows and the direction of the currency, then sure, do that. It's not something that's probably going to really affect you that much over time. So feel free, but my view is that's just a bit of a waste. All right, we don't have any live questions, so we'll move back onto the list.
If you have questions and you don't feel like speaking, just add us on Twitter and we'll see you and then we can answer those.
Okay, let's go with the one that came out in advance. Bob, I don't know how much you know about Finning, the stock, but we had a question on that one. So for those of you who aren't that familiar, Finning is the owner of Caterpillar dealerships in Western Canada, various countries in South America, and then the UK and Ireland. So they sell the big tractors, but they also sell service to these tractors. So this is a stock that's done incredibly well. I bought this one at, I think about 36 the first time, and then closer to 30 the second time. It's now close to one, actually it went up to about 110 even at one point. So the bull case on this is that you look at Western Canada, you have the oil sands. The oil sands are expanding. There's various measures in place in terms of trying to get more pipeline exposure. And that is ultimately good for Finning. The other part that's good for Finning is in South America. Chile is one of the places where they have the exclusive rights to the country. So if you want to buy a Caterpillar big earth moving machine in Chile, you got to go to Finning. There's no other choice. Obviously, you can buy competing big heavy equipment, but and some companies might, some not. Chile is also, there's the boom in rare earths, there, lithium, copper, things like that. So basically, you have this company that looks on the long term to be this play on natural resources, and the natural resources are doing right now. My view is that it's gone up a long way very quickly. I think it trades at about 25 times free cash flow. When I was buying it, it traded for about 8 times free cash flow. So there's a ton of multiple expansion there. The business is getting better. Like earnings will go up over time if the commodity boom continued. The issue is that whether that commodity boom will continue or not. And I really have, in the long term, I think that these rare earths are probably a trend that is here to stay. So I would probably just hold. I wouldn't buy right now. I'm not super excited about the price. If it went back to where I was buying it, I'd be much more interested. Bob, any thoughts on that one? Do you know that one?
Yeah, I don't know if getting too well. I just did a quick look up on Google Finance. Yeah, it seems the price is a bit high right now. I can't say I'm an expert on that sector. Yeah, whatever Nelson you said, I think it makes sense, especially if the price is risen quite a bit. Another question we received was for some stocks you bought early on that you're glad you held on, and which one you wish you had never touched. So Nelson, I'll let you answer that first.
Ooh. In the fall of 2018, the TSX did this crazy, I think it fell, I'm going to say it was a bear market. It was a 20% fall from peak to trough. And I'm going to say that in that month of kind of November, December, stocks were down 10 or 15% this month. And I had some cash and I don't remember why, but I had a bunch of cash and I just kind of went crazy and buying stuff. And one that I bought back then was Great West Life, which at the time looked like this really boring kind of life insurance company, but I was paying about 8 times earnings. I remember the dividend yield was in excess of about 4%. And I was like, this is just the kind of good, solid company that I need to own and my portfolio needed more. Remember, this is 2018. I wasn't really a hardcore dividend investor at that point. I was more of a value, deep value kind of guy. I was working towards how I invest today. So that was one that I bought back then. I've just held it for such a long time that it's kind of one of those stocks that it's not a very big part of my portfolio. Even now, as it's gone up, I think I paid $28 or something, and now it's tripled, and the dividend's gone up, and it's just been this really nice performing kind of ballast to my portfolio. It was just the boring names that I really like, and so that is one that it's just I look back and it's like I probably just stumbled upon this, but it ended up being a really good buy for me, and it's something that I think I'm going to hold for another decade or two. That's just a good, solid company. Stock that I wish I would have never seen or that I bought early on, Artis REIT, which is now RFA Financial. It was always this company that traded at this discount to book value and a cheap price to earnings multiple. And I looked at it as, ooh, look at all this cheap real estate that I can buy. And over time, I came to realize that REITs, especially, you want quality. You want a company that is increasing its earnings and increasing its distributions over time, because good real estate, in my view, just keeps getting better and better, and mediocre real estate just doesn't. Good real estate, you get rent increases, it's easier to rent, so on and so on. And Artis's portfolio was just a bunch of mediocre real estate that the market realized and that I did not realize. I held that one for way too long. Probably, I don't even know if I broke even on it. It was a dog. And just for me, it really personified the way I looked at REITs and the way I look at the kind of stocks in general, where it's just not a value thing. I want quality, and then I'll wait for quality to go on sale.
So on my side, one stock I'm really glad we got in early on would be Waste Management, WM. It was on the US side. So I think we got in, I can't remember when we got in, but we're looking at over 5 times the return now. It's just a boring stock. It has done well. Now, having said that, this past year, it seemed to kind of struggle a little bit, but that's just the tendency in this sector. Yeah, it's just people produce garbage. There's needs to be a way to get rid of the garbage. So it's a business that's easy to understand. So that's one. Glad to got into it early on. Apple, probably one of the stocks that I'm happy to got in early. I wish I had gotten in earlier. I actually play around with the original iPhone like a few weeks when they came out. So I was blown away with the experience, but I didn't have the foresight to get into the stock back then. I actually got Apple stocks 6 months later, a year later. So if I gotten in earlier, it would be an even bigger return. So those two, yeah, I guess I have to include the Canadian banks. Just whenever it's at 52-week low or even lower, I have the tendency to buy some. It worked out pretty well, especially TD. So that was good. A stock that I wish never touched would be Algonquin Power and Utilities Corporation, AQN. I think a lot of the dividend growth investors got sucked into that one because the stock was growing dividends and it had a lot of promising futures, but the company just got into way too much debt. And if you look at the chart, the 5-year return is minus 50%. So that kind of sucked. So we definitely lost money there. So that's one stock I wish I had the foresight to not get into it. When we purchased, we knew there was quite a bit of debt, but we thought it would be okay. But that wasn't correct.
Okay, we have a question from Dave. He would like to know about OpenText. And then in general, are there any Canadian dividend growers that you see as good value right now? We did talk about this a little bit earlier, Dave. So Bob, maybe talk about OpenText and then quickly anything that you think is attractive today.
Yeah, so it looks like the share price has dropped quite a bit. In the past 5 years, it's minus 50%. In the past 5 years, past year is minus 20%. So yeah, I mean, we don't own it. It looks like it's obviously a tech stock and it's have obviously struggled a bit. I can't say I know too much about it. Yeah, I think I can't say I know too much about this. I think you do more research than me when it comes to this kind of companies.
So this one is a little bit interesting for me. I'll share my story with it. I did own it at one point, and then fairly recently, maybe a year to 18 months ago. So when I did work on it, my understanding of OpenText is it's a cloud company, and their thing is that they help businesses organize the cloud and get more out of their data. So what that kind of means, my interpretation of it, and this is tough for me because I don't really understand tech that well, but my interpretation of it was that the cloud is this big cluster, of a place, and companies need help organizing it. They need help using it. They need help from cloud experts, and OpenText is these cloud experts. And of course, now with AI, the thought is that AI is going to replace that OpenText technology. For me, I looked at it and I said, okay, I understand the concept, but I realized that as I owned it, that I don't understand this business enough to have confidence in the next sell-off, where it's like, this thing sells off. I really don't understand it well enough to be able to say, hey, I know what's going on here, and I would have confidence in that. So I booked it for a nice little gain and moved on with my life. And it's back to, I think, right around where I paid for it these days. So for me, I just don't understand tech well enough. And it was a good thing for me because it was this representation of, hey, I really don't understand this sector very well. There's a lot of tech companies where it's, man, like I don't understand why you would use OpenText to organize your cloud data versus a competitor versus like if some other company, Microsoft comes in and they say, hey, we're gonna do software for cloud organization. Was it built into the Microsoft cloud? These are all questions that I couldn't answer. So I thought, I don't know this business well enough. I better sell it. Dave, that's my response, is that I don't know it well enough to be confident in the future. So I sold.
Yeah. So I just did some quick research while we were talking, just went on their website, did a quick look on their quarterly numbers, their reports and stuff. I mean, tech, this should be like pretty familiar to me, but I can't get a good sense of what their moat is. I don't know. Again, this is a quick 2-minute research, just going on their website and stuff. I can't get a sense, like Nelson, just like you, I can't get a good sense of what's their competitive advantage over another company. With that, I'm just like, I don't have the confidence to put my money in this because I can't explain to my kids what this company does.
And to be fair,
and why they're so much better than another one.
I was going to say, to be fair, we might be idiots, especially me. And if you're in the space, you might be able to figure this out better than we can, especially if maybe you're in the cloud part of tech. For me, the lesson was, hey, I don't know this super well. I should not be in this company. I stick to things that I can understand, things that are physical too.
Okay, let's move on to another question. So both of us are dividend investors, and I'm more hybrid, but there's a question from a few readers. It's when a holding cuts dividend, do you immediately sell? If not, why not? So Nelson, I'll let you answer first.
I go back and forth on this, and my thinking right now, okay, so I'll talk a little bit about my thinking before, and then I'll talk about my thinking right now. So before, when I was more of a value oriented guy, it was, hey, generally when a company cuts the dividend, it is the bottom, everybody's out of it, all the dividend guys have left. Therefore, maybe it's a good time to buy it. And so I would look at the valuation and I would look at it as a bottom fishing sort of exercise. And I did that with Algonquin when it cut the dividend for the first time. I did that with AltaGas. Actually, that was one that I did back in, I think, 2018, 2019, which worked out really well for me, actually. And the Algonquin one did not. So back then it was like this value thing. But now it's if quality is important, and I think quality is more and more important as I go along and as I mature as an investor. So these days, I'm much more inclined to just sell and get out. And so I still own some TELUS, but I don't know about selling that. See, this is where I struggle with it, right? Because the rule says that if it cuts the dividend, the quality isn't there. Therefore, I should get out. And that's just a simple way to look at it. And then the value part of my brain kicks in. So it's cheap and there's some turnaround potential.
On one hand, if it makes the perfect sense to cut dividends so the company could clean out the books, call TELUS, that makes sense, right? What you don't want to see is company taking on additional debt to pay out dividends. It's like, that doesn't make sense. So when a company cut dividends to clean up their books and get their finances in order, I applaud for that. So that seems to make sense, especially from a value point of view, to continue to hold that particular company, right? Now, some companies, they may surprise investors and cut dividends. Those ones I tend to sell because I'm like, oh, man, I can't believe or trust the management anymore. One example was, I can't remember, it was REIT, where I think it was RioCan actually. RioCan during COVID, the CEO came out and was like, yeah, we're not cutting dividends. There's no way. And a few weeks later, they cut dividends. I'm like, yeah, I can't trust this management group anymore. I'm out. So you kind of have to decide on your own. Now, I know some investors just, whenever dividends cut, they just sell it regardless. But I think that's dangerous because it's not always black and white, right? So you need to step back and figure out, does it make sense to continue to hold this, or does it make sense to just sell it?
How about this one? I like this one. What's the biggest difference between how you invested in your 20s or 30s versus now? Besides the fact that this is exposing how old we are. Bob, let's go first. How have you changed over time?
I don't know if I changed that much over time. I think I'm maybe more patient. Maybe in my 20s or 30s, I tend to hold on to a lot of cash and only buy stocks when they're at a 52-week low. But over time, I learned that you may not have any chance to get in when the stock is at a fair valuation. Like, for example, if you arbitrarily said that you're not going to buy TD until it hits $100, just for some reason, you think the stock is too expensive, you set a price for yourself, you're not going to get into $100. But if the TD share price goes down to, say, 110, do you go in, or do you just say, no, I set the price at $100. I'm not buying any until it hits 100. The thing is, it may never get to $100. So you may miss out on some really good companies because you have this silly rule that you set up for yourself. So what I learned is now, been investing for 15, 20 years, is that time in the market is way more important than time in the market. Yeah, you could buy some stocks at 52-week high, but if the stock continue to go up, who cares, right? So that's probably one of the biggest differences. Another one would probably be, don't focus too much on the dividend payout increase streak. I made a mistake of looking up the spreadsheet. In Canada, there's one. In the US, there's one where there's like a massive spreadsheet and list all the dividend all stars or kins or whatever. In my late 20s or early 30s, I was like going through the list. I was like, oh, this one looks interesting. It's been increasing dividend for 10 plus years, 15 plus years. Must be really safe. And I've got myself into trouble with that because I was focused on the numbers. I didn't step back and look at the macro environment of these companies. So like AQN was a prime example. LP Iranian Bank, right? Like on the spreadsheet looks good because they've been raising dividends. They have good dividend increase streaks and they've been increasing dividends quite well. But when you step back and look at their businesses, you're like, wait a minute, there's something wrong with this. It's not looking good. But I think we talked about a few episodes ago about our bold predictions, and I predicted that Canadian utility may cut dividend in the next 5 years. Why? Because it has 50 something year dividend increase streak, but when you look at each year, they've been increasing less and less than 1%. So when you step back, you're like, does it make sense for this streak to keep going or not? Right. So that's where I learned you need to sometimes step back and look at the big picture. Nelson, what about you?
If you have rigid rules, you will miss opportunities. And I'm going to talk about something that recently I relaxed my rules a little bit, if you want to call it that. And so those of you who follow the newsletter, you know that I'm a big fan of IA Financial. So that is a Canadian life insurance company out of Quebec. It's the smallest of the Canadian life insurance companies. They're expanding more into kind of financial services. So they have a dealer services arm, which is when you go to the car dealership, you buy a new car, they're trying to push all that crap on you. That's IA Financial makes money. In March, it fell from 170 to like that 150 range, which wasn't quite a 52-week low. And I was like, I think it's going to go lower. I'm not going to do anything. And it rallied back up to 170 in call it like a month and a half later. And I was like, man, Nelson, what are you doing? It's a good company. It was trading at a good valuation. And I just, like Charlie Munger used to say, I thumb sucked and I didn't actually buy it. So then in May, the quarterly earnings came out and I thought they were pretty good. And the market did not agree with me. And it went from kind of 175 all the way back down to 160 again. And I said, okay, I'm not missing my chance this time. I'm buying it, even though it was higher than the lows before, but all of the things that I was bullish about still stood. Anyway, now as we're recording this, it's 194.99. So obviously that was a good move for me. So the point is that you have rules, and I like buying stuff at 52-week lows. I like buying stuff at low valuations and high dividend yields. And IA Financial did not check off those boxes, but sometimes it's still a good buy, even though it breaks your rules. And that is something that I have learned over the years as well, where it's have rules, have discipline, but don't be married to them. Have a little bit of flexibility in your plan. And if there's good company that you want to own, just buy it. Don't feel the need to wait for the perfect entry point, because the perfect entry point might not come.
All right. Do you want to do one more question before we go into lightning round or rapid fire?
Let's do that. All right, Bob, if someone handed you $100,000 tomorrow, what would be your plan?
That's a fun one. No, I would never. Yeah, that's a very good question. I would probably, since we're getting pretty close on calling the early retirement thing, I would probably put aside, say, 20K on cash reserve, just set that aside. 80K, I would invest into the market. I would probably, that's divided by 4. So I'll pick four stocks and invest equally 20K. So I would probably go 20K into XAW, which is the iShare X Canada index. So just get some global exposure. I would probably do 20K on Google, just because they've been getting hit with the AI. I think Google will just do fine over the long term, even though there is some concerns about spending too much on AI and such. But Google consistently surprise everybody. Whenever people tell Google, they tend to turn around and surprise everybody. So that would be my second pick. And then the other 2 stocks, I'll probably coin flip and pick between Royal Bank or TD. Maybe Royal Bank because TD right now is a little bit higher than Royal Bank in terms of percentage in our portfolio. So I'll probably pick Royal Bank. And then the last 20K, I might gamble a little bit, see as a play money. I might put it in Micron. But I would do that 20K, almost watch it very closely. I would probably set an upper limit. If I return 20%, I would sell it. And if the thing goes down by 10%, I would sell it. So I would set stop loss, like limit too. So I limit my gain or loss. Right. So that's what I would do. But it would be tempting to do K and just spend that all in vacation and travel first class and all that. But I can't get myself to do that.
Bob, if you did get free money like that, whether it's an inheritance or your gambling addiction pays off. No, Bob doesn't have a gambling addiction. I'm just kidding. Would you view that money differently as, hey, it's more fun money, or is it like, hey, capital is precious and it all deserves the same respect?
I think it's the latter. It's money is money. You need to respect it. You can't just say, oh, that's free money I got, and then just blow it all. I think you need to respect that money. Nelson?
I agree with that. And what I would do in terms of if someone gave me $100,000 today, I would put it in a money market account. I'm patiently waiting for the next correction, and I would love to put more money in stocks at that point. Okay, time for the lightning round. So very quick answers, very quick questions. We'll try to get through as many of these as possible. So we'll start. Bob, gold in your portfolio, yes or no?
Nope. I just don't know enough about gold. And I think that just doesn't really go up that much over time. It seems to be go up and down. So no, I'm not a precious metal person.
I agree, except one thing. I think gold coins are cool. And I would buy gold coins if the price of gold was gold gets when it's at the bottom of its cycle and everyone hates it. Why would anyone bother owning gold? I would buy gold coins at that point because I think they're cool and it feels like owning treasure.
Okay.
You go ahead.
You want to pick one? Okay. Costco, Superstore, Walmart.
The easy answer is wherever the best sales are, all of them. I'm passionate about this. Shop the flyer deals. Of course, Costco doesn't have flyers, so that's a different one. But when something is cheap, especially meat, produce, not so much, you go and you buy a whole bunch of it and you portion it out and you freeze it. And that is how you save money as a consumer. So my answer is I go to all three. I vault through the deals, and the guys who work at the store hate guys like that, but I don't care. I'm one of them.
For me, I would tend to go to Costco more for bulk stuff, right? We just recently bought a big chunk of beef. I think it's like some sort of sirloin, and I cut it up and put it in the freezer, like bag it. I think I ended up with 20 steaks, I think, and it was so much cheaper than buying the pack. So Costco's good, Superstore, Walmart, whatever deal you could find. I'm not loyal to any of them, so that's my answer.
And for just a quick here, if you're nervous about processing your own meat, YouTube has tons of videos. They make it easy for you. You just need a good knife and some patience and the desire to get your counter all bloody because it will come off of the cutting board, but that's fine. Okay. Questrade or Wealthsimple, favorite brokerage?
If you asked me 5 years ago, probably Questrade, but now I like Wealthsimple. I was kind of iffy about the app trading, like everything via app, but their web interface is getting a lot better. Wealthsimple is just throwing so much free stuff. Once you hit a certain category, they give you rewards and can't beat out free stuff, right? Lounge access. Now we got a 10 gig global eSIM. So when we travel, we don't have to pay for roaming or an extra eSIM. So I like Wealthsimple.
I agree. And the fact that they are paying me to come over to them is just the cherry on top of the sundae.
Yeah, and also, sorry, just to add, Wealthsimple, like between the two, I find Wealthsimple's support so much better compared to Questrade.
Wealthsimple has really screwed up the whole Canadian brokerage scene, and companies are willing to pay to play. So I think that as an investor, you should be looking at making that change if it makes sense in terms of getting those bonuses to transfer over, because it's free money, and the law is a little bit iffy on it, but my understanding is that it is not taxed. Okay, Bob, what's the most overrated fire advice?
The latte rule, latte factor, don't buy latte outside, save that money. I guess latte nowadays are kind of expensive, like $5, $6 a cup. If you enjoy latte, go for it. Focus on the bigger expenses, right? Like I know people that are freaking out about buying coffee outside and then they have no problem spending 30, 40K every other year. Wait a minute. Like also, for example, there's also, how EV is very popular now. People are like, oh, we'll save gas money by switching to EV. And they're paying, $30,000, $40,000 extra just to save or $60 a month. That doesn't make any sense. I think it's important to know where your money is going, and you should try to save as much as you can, but you also need to enjoy life a little bit.
I'm not sure if this is overrated, but the emphasis on, or I guess what other people put the emphasis on fire, is they put so much emphasis on the retire early part and very little emphasis on the FI part. Whenever you get into these debates online about fire, it's always I could never retire early. I'd be bored, blah, 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 blah. And it's cool. Great. The point of fire is the financial independence part. And then you can just do whatever you want. Mark Seed, friend of the podcast, he calls it FI Woot, which is work on own terms. I prefer FIs, which is financial independence, selfish employment. At the end of the day, the ability to do whatever you want is the important part. If you want to sit at home and play video games, by all means. And if you want to do a project that maybe isn't compensated very well, say a Canadian dividend investing newsletter, you can do that as well.
Okay, one more. Biggest splurge you don't regret?
I went to game 1 of the World Series with the Blue Jays and the Dodgers. It was a very last minute thing, of course, because you didn't know they were in the World Series. That cost a lot of money, and not just for tickets either. But what a fun atmosphere. Something I'm going to remember for the rest of my life. I do not regret that for a second.
For me, it would be many family trips. We just went to Japan back in March with a surprise trip for the kids. We probably spent, $20K on that, everything included. Could have spent more, but it was money well spent. Got to see Mount Fuji, had really great food. Well, we still talk about it. Yeah, anything travel related, totally worth it.
This is the season finale, and then in September, we're going to do season 2.
Yeah, I think that's the general thoughts. Sometime in September, we'll go season 2. I know Nelson and I have been talking about doing video, so maybe we'll try that. Might be a little bit more tricky, but we'll see. Maybe I'll give that a try and see how it works.
Yeah, that is our number 2 request. Number 1 request is, and this is rude, is that no more Nelson on the podcast. I just wanted to say that season 1, we are closing in on 40,000 listens, downloads, 40,000 downloads. I would say that going into this, Bob, I just wanted to chat and have a nice time with somebody. So I appreciate that you're doing this with me, and the fact that we can reach so many Canadians. I get people in real life come and tell me, hey, we listen to the podcast, we love it. And I just fills me up with pride every time that happens. So thank you everyone for listening. We appreciate you. Season 2 is going to be even better. And what a fun project for us to help pass the time.
Yeah, it's been fun, and it's always fun to chat. And for those of you wondering how we prepare, we don't really prepare most of the time. Nelson and I literally just get on the podcast. We're like, what are we talking about today? And we talk about 3 different topics, and we're like, oh, let's go with this one. And we start talking. It's been interesting.
That's a lot of fun. I think we'll have more guests next year as well. So if you're listening, you want to come on, by all means. And I see there's a few of you here that I'd be interested in having them on. So I'll probably reach out to people more directly. And I've talked to some other people as well. So I think we're going to do that next time or next season as well. Anyway, we're excited. Thanks for listening again. And we appreciate everyone.
Thanks, everybody.
If you enjoyed the show, make sure you subscribe to never miss another episode. For more from Bob, visit his site at tawcan.com. That's TAWCAN, all one word. Nelson can be found at CanadianDividendInvesting.com. They're both on Twitter as well. Just search for Tawcan or CDI Newsletter. Thanks. See you next time.